Thank you for tuning in to 21stCenturyIncome.com. So today we're talking about what we hear in the news called the subprime mess, or the subprime fiasco, mortgage meltdown, and many fixes that you're seeing on TV put forth by the President or Treasury Secretary Paulson. So without taking too much of our time about how we got to this place, suffice it to say that the simplistic reason is that for the first time on any grand scale, you have the people who lend money are separated from the people who actually are going to pay that money back. And in previous times when a bank lent money, a bank cared deeply about whether they were repaid or not. So today in the modern world, we have something called a process that's called securitization. Securitization means that the bank makes the loan, and then the bank sells that loan off, packages it up with other loans, and sells it off to investors. And when the bank completes that sale, they have now been paid back. So what actually happens to that loan, whether the borrower can actually afford it or not, is really not of consequence to the bank, certainly at the time when they made the loan. I mean, as we're learning now, it may in fact have consequences for them. What I want us to focus on is, as 21st century investors, how do we be opportunistic? What's obvious is that we live in a time of great turbulence, financial turbulence, and a time of many financial excesses. And as a result of those excesses and the turbulence that comes from them, it creates opportunities and it creates chances for good investors to be opportunistic. And if you recall, if you go back and look at some of my previous blogs, if you are a 21st century investor, what that means is that you have to think in terms of decades. You have to think in terms of, how do I build a stream of income that's going to last me for many years in the future, what might be decades? That immediately makes you start to think, or should start to think, like what we call a real money investor. What's a real money investor? A big pension fund, insurance companies, endowments, people like Warren Buffett. It means people who are not buying with borrowed money, people who are buying with long-term time horizons. And as a result of this turbulence, there are great investments to be made right now that will bear fruit 3 years from now, 5 years from now. And that's how a real money investor thinks. That's how a big insurance company or a big pension fund thinks. So in the 21st century, generating 21st century income, it means that you have to be opportunistic. It means you have to have a very flexible thinking. And it also means that you need to think a little bit differently. And by thinking differently, it means when you have a very long-term time horizon, you can make opportunistic investments. So there are very, very interesting finance companies, interesting banks, small banks. The banks who were doing this whole securitization, were many of the big banks, the household names that you know. But the smaller banks, the banks that you might see in your local town, small community banks, which are called portfolio lenders. Portfolio lender means that they don't actually sell those loans. They keep those loans on the books, kind of the old-fashioned way, so to speak. Now, one of the consequences is that as everyone has become scared of subprime, scared of CEO, all these acronyms, they of course have sold all the stocks of all of the banks. And many of the smaller regional banks have very good dividends, dividends in the range of 4, 5, 6%, with a history of increasing dividends. Remember, 21st century income, you have to generate ever-increasing income for years out into the future. Well, what a great way to do that, by opportunistically buying very, very conservative, well-run banks that have a history of increasing their dividends, whose stock prices have been absolutely decimated because We live in a very fast-paced world where everyone, as soon as there are any of these disturbances, pretty much everything gets sold immediately. So, but let me go back to being opportunistic and thinking. One of the consequences of this whole subprime CDO dislocation, for lack of a better word, is going to be, rightly or wrongly, a lowering of interest rates. And a lowering of interest rates means that the what's called the yield curve, the shorter rates versus the longer rates, becomes more positively sloped. It looks sort of like a hockey stick. And banks lend money long term, and their cost of money is the short-term rate. So what's going to happen is, as the short-term rate goes down, the banks are going to be able to make more money going forward. So if you think about some of these smaller banks we're talking about, or these regional banks, they're going to have a lower cost of money in the future, in the very near future. So their cost of money is going to go down, and the rate that they're going to charge is going to either stay the same or perhaps even go up because of some of the bigger banks might be pulling back from some of these various mortgage lending areas. And it's a great way for the portfolio lenders to step in and provide loans, provide liquidity. So being a 21st century investor, thinking like a real money investor, you can think opportunistically about acquiring some of these companies at what I believe 3 to 5 years from now are going to look like bargain basement prices. And these are companies, these are banks that have a history of increasing dividends, that are conservatively run, and you can put them in your portfolio and enjoy those dividends for many, many years to come. That's one example. We'll be back with more. Thank you.